Hello friends, this is Raj Sastry from Raj Option Trading. Today we will talk about my favorite top cybersecurity stocks. So these cybersecurity stocks are on the fire of late, mainly because everybody's working from home and companies need protection for their valuable assets. So with that in mind, let's look at various categories of cybersecurity companies. The first category is really the firewall and endpoint security. So in this section, we got some of the very popular companies like CrowdStrike, Cloudflare, F5 Networks, Palo Alto, Fortinet, Checkpoint, and FireEye. Think about these as end-to-end solution providers. And then we got secure access like Zscaler, CyberArk, and we have identity providers like Okta, which is the industry standard of late. And we got Ping and SailPoint. And then we got some of the smaller players around security as a service, email and web. So we got Proofpoint and MIME as an example here. And we have security policy assessment type companies. We got QLYS and Tufin software. And then we got visibility to cybersecurity exposure. We got Tenable and Splunk. And last but not least, we got consumer-oriented cybersecurity companies. A good example is NortonLifeLock. I specifically did not cover some of the larger players here, like Cisco as an example, which is a provider of multiple solution stacks, including collaboration, security, and networking products. With that in mind, these are really pure play software companies. Let's dive in. And if you look at Cloudflare, it's a leading performance and security company, and company runs world's largest networks. And 94% of employees approve the co-founder Matthew Prince, and it's about $24 billion stock, and the market cap is really increasing of late. And next is CrowdStrike. CrowdStrike is a new player here in the market, and they're redefining the security for the cloud era. And it's a $47 billion company, and 98% approve the co-founder and CEO George Kurtz. I think this is one of the biggest companies in this report. Next is Palo Alto Networks. It's a very good player here, and they provide next generation security. And 76% approve the CEO Nikesh Arora. Then we got Fortinet. They provide top-rated network content security, and they also provide intelligence and work from intelligence and work together to form a cooperative fabrics. And they're a $24.1 billion company, and 95% approve founder and CEO Ken Xi. Next, we got Checkpoint. It's a one of the famous good old companies, and it's about $18 billion market cap, and it provides the comprehensive security solutions. They started as a firewall company, very famous back in good old days, and 80% of the employees approve CEO Jill Should. Then you got Proofpoint. Proofpoint is a little smaller company, as you can see here, a leading company that protects organizations, and they got integrated suite to protect organizations. And they also play in the compliance type area, and 93% of the employees approve the chairman and CEO Gary. Next, we got Zscaler. This is again born in the cloud type company, just a recent IPO, not too recent though, about $27 billion company, and it's actually grabbing the market share and revenue on a faster pace. And the founder is really Jay Chowdhury here, and 98% approve the CEO. Next, we got SailPoint Technologies, Sail, and they're into identity, like we talked about. They provide identity solutions, and 92% approve the co-founder and CEO, Mark McLean, and they got about $5 billion market cap. Last but not least is Okta. It's becoming an industry standard when it comes to the identity solution. Think about you're logging into a corporate network or any website. Most of the security can be handled through Okta pretty seamlessly. 96% approve the co-founder and CEO, Todd McKinnon, who is a former employee of Salesforce.com. Market cap is about $33 billion. This is probably one of the biggest players in the identity management solution. So with that, let's dive into these companies in a little more detail. Let's look at some numbers here, including market cap, their performance, revenue, cash, debt, and margins. So with that in mind, the first company we'll cover is CrowdStrike, and it's a USA-based company. Price is about $215. It's a couple days old, and we got a market cap of $47 billion. Yearly performance is 245.56. Impressive yearly performance, as you can see here. And they got a revenue growth of 85.80. So it's an impressive revenue growth. And they got operating cash flow positive and free cash flow also positive. They got good amount of cash at hand, about $1.6 billion. A little bit debt here, and gross margin is very healthy, for a SaaS company. And profit margin is negative. They're losing money still. So with that in mind, if you look at both revenue growth, which is 85%, and if you look at the gross margin, very healthy. So it's a sign of a good company, and they're also grabbing market share left and right. Next is Cloudflare, symbol is NET, and it's again a USA-based company. Stock price is about $80 billion, $24 billion market cap. If you look at the performance here, very impressive. They are actually doing very well. Performance for the year is 318%. And the revenue, it's a law of smaller numbers, I guess. The revenue itself is 389 million, but the revenue growth is 54%. And they got, right now they're operating cash flow negative and free cash flow negative. And they got, $1 billion cash, some debt. They acquired some debt, and gross margin is very healthy. So if you look at the revenue growth, which is 54%, and the gross margin itself, which is 76%, very impressive. So I would recommend Cloudflare, for a growth stock. Next is Palo Alto, F5 Network, one of the good old companies here, and it's got a market cap of 12.41 billion, and revenue growth is a little bit low, as you can see here. But nonetheless, it's almost approaching the double-digit revenue growth, which is not bad, and impressive gross margin, which is $82 billion, and they got good amount of cash on hand, and debt is also not manageable, and they're also profit margin positive, so it's a a good company. Next is Palo Alto Networks. It's one of the newer companies, maybe a couple of years old, and market cap is $33 billion, and performance is about 47. This is where as the company gets bigger, if you can see revenue of 3.58 billion, you can only put so much growth. So they have put across 22% revenue growth over year, and they got operating cash positive. They got cash at hand, and they also have some debt, as you can see here, almost same amount of debt as they have cash on hand, and impressive 70% gross margin, and profit margin itself is negative. So it's one of the solid companies for long term. Next is Fortinet, FTNT. Again, its market cap is $24 billion. Performance is 22% year over year. And revenue is a little less, as you can see here, 2.46 billion. Revenue growth itself is 18%, which is double digit, and they got the operating cash flow as well as free cash flow, and they got cash at hand, which is pretty impressive, and very good gross margin. So that's why double digit revenue growth and good gross margin. It's a recommendation to buy. Next is Checkpoint, a good old firewall company based in Israel, and they have done a good revenue growth, which is 18%, and they also have good amount of cash, and debt is manageable. Very conservative company. It's a good company for the longer term holding. As I'm speaking today, they just announced their quarterly earning and stock dipped a little bit. So it's a good time to buy Checkpoint because of the dip. Next is FireEye. FireEye is also a firewall type company. Stock price is very low, as you can see here, and market cap is also a little bit low. This company has its own ups and downs. I think right now as we speak, the company stock itself is a little bit down, a good entry point, but I would not hold my breath for a impressive growth. It's a little bit slower growing companies, and revenue growth is 5.60%, not too much, and they got impressive gross margin. So overall, it's a good company. I would watch out for the debt level. Debt itself is about $1 billion, more than the cash on hand. Next is Zscaler. So this is a company bought in the cloud type company, secure access to internet, and $27 billion company. It's rapidly improving its stock price of late. Performance is very impressive, 246.16%, and revenue itself is good, and revenue growth is 52%. Operating cash positive, free cash flow positive. They got impressive amount of cash on hand, and gross margin is 77%. So if you look at both revenue growth coupled with the good gross margin, that makes it ideal candidate for long-term buy. Next is CyberArk. CyberArk, is again Israeli-based company, and they got about 13% price appreciation or the performance over the last year, and revenue growth is negative, as you can see here. That's one of the reason I'm not recommending this, but it's a steady Eddie type stock with an impressive gross margin. Next is Okta. Okta is a very good identity management company. Its CEO Todd McKinnon is a ex-Salesforce.com executive, and I think he's doing a very good job, managing this company and leading the company. And they got 94% performance over the last year, and impressive revenue growth. It's 42%. Free cash flow and operating cash flow positive. Good amount of cash, $2.54 billion. I think it's the most in this cybersecurity companies. And they got $1.95 billion debt and good gross margin. So that makes it an ideal candidate coupled with the good gross margin and a impressive revenue growth. Next is Ping Identity. So Ping Identity is, it was a new entrant to the security, market a while ago with the identity solution, but of late, company is not doing that great. So as you can see here, 17% performance over the last year, and revenue growth itself is negative. So I would not recommend this stock for going forward. SailPoint, these guys are also into identity solutions, but they're doing, relatively very well. Impressive 115% revenue performance over the last year, and revenue growth itself is 23.90%. and they also have a good gross margin and free cash flow positive. I would recommend SailPoint going forward. Next is Proofpoint. So Proofpoint is $7.52 billion company. Performance is less, as you can see. It's got its ups and downs, but impressive revenue growth over the last year, and they also have good gross margin, as you can see here. That's why it's a company that I would recommend. So it's a good company to stick with. Mimecast, it's a smaller player, UK based company, about $2.7 billion company. They did not do well. This company is good when it's down, and then look for a bounce and a trade. It's a good company for trading because a lot of fluctuations. Next is QLYS. It's a good company, and $5.3 billion company. Very good performance over the last year. 59.51. Revenue growth is double digit, which is good, and they got a good amount of gross margin, and they're also free cash flow positive. Next is Tufin Software, Israeli based company, and they've got a performance is 21.42 percentage, and they got as you can see, operating cash flow and free cash flow is negative, but good amount of gross margin. So it's a good company. I would watch. No, I would not buy it, but I would watch it. Next is Tenable Holdings, TENB, USA based company. Performance is about 79.83 percentage, and good revenue growth 22%. Operating cash flow positive, free cash flow positive, 81% gross margin. I would recommend Tenable Holdings. And then we got Splunk. What can I say about Splunk? It's a good old company, and they're into logging, security, data, and they used to do very well, but off late I think they're not doing great. As you can see here, performance over last year, when all the work at home companies are doing well, this company did a 4% performance, and if you can see, revenue growth is also negative. So it's one of those good companies which used to do well but now fallen off the grace, especially with a lot of players in the data area, with with the players like Datadog, and other companies. This is kind of I think losing into some competition, I would think. Next is NLOK or NortonLifeLock. These guys are into consumer security play, and they're doing very well. 28 percentage performance, and revenue growth is also positive, and impressive gross margin, as you can see here. It's a lower stock price is a little low. I think it's a good one to trade in and out. So with that, let's look at the performance on a monthly basis and see what we glean from. So CrowdStrike, it's one of the famous companies. I would recommend this Steady Eddie. It's got some good performance on a monthly basis. I think October and March, couple months a little bit lower, but on an overall basis, in a good solid company, you don't see too many reds here. Next is Cloudflare, same story here, Steady Eddie type company doing very well. F5, these guys have got some ups and downs, as you can see here. They have some down months, and I would, normally the way I do for F5 is really when they are beaten down, I would buy some and trade them in and out. I would also do some Delta 70 calls when they're really down. Next is Palo Alto Network. It's company has done solid under Nikesh Arora's leadership. I would buy this company. Nice company to for the long term. Fortinet is it's also a good company. As you can see, there are some red here or a lot of reds here. So I would buy when it dips and trade it in and out. Checkpoint is a steady Eddie. It's a very conservatively run company. The good old Checkpoint with the firewalls, and it's a good company. Stock just fell due to earnings call today. A good company to own. FireEye, it's got its ups and downs. So this is a good company for trading, probably not for long-term owning. As you can see, the fluctuations here: 53% up and 20% down, 17% down. Some good fluctuation. So good company to trade in and out. Zscaler has done very well with the leadership of the Chowdhury, Mr. Chowdhury, and I would recommend owning this. Watch out because it's gone up exponentially off late, but it's a good company to own, especially after some pullback. CyberArk is a again it's got some reds here. I would not own it for long term, but I would buy when it's pulled back. Okta is a clear leader in the identity management space. I would buy this company, solid company with a good cash balance. Ping, I would not buy this company. If you want to trade, it's okay, but don't own it for long term because very stiff competition among the identity management solutions. Okta and SailPoint are doing very well. Ping is not doing that great. SailPoint is a good company, as you can see, a lot of greens and few reds, but I would buy SailPoint here. Proofpoint, it's got its ups and downs. So I'd buy when it's down and take it from there. MIME is again a trading type stock. It's got its fluctuations. You'd trade in and out. Tenable is a good stock. QLYS is also it's a good stock, but it's got some dips, as you can see here. I would buy it on a dip and take it from there. And Tufin is a relatively good company here. In the past they got some reds, but now they're doing okay. Splunk, I would watch out because off late they'd been fallen off the grace, not doing that great. So I would watch out for this company. As you can see here, they got 16% down and then 2% down. Now they seem to be recovering a little bit. Maybe good time to buy a little bit and take it from there. NortonLifeLock is a consumer type security company. I think it's a good company, low dollar stock. It's good to buy or even trade. So with that, let's look at few companies that we want to really deep dive on. So with that, Cloudflare, we talked through Cloudflare. This is a 3-year chart of Cloudflare, courtesy of Charles Schwab. So as you can see, in 3 years, it has done 63.95. I mean, it's done 355.28%, which is an impressive feat. And from a market cap perspective, Cloudflare has improved its market caps. As you can see here, it was $512 billion company. Then it became 712, 10, 12, 24. So from last year to this year, they almost doubled their market cap, which is a positive sign. It shows companies grabbing the market share. And the revenue also, as you can see here, in the latest quarter, they did a 54% year-over-year revenue, which is an impressive feat for a company. And they got 47% in the year before, quarter before, 47% revenue growth, 47. Consistently they are they're giving a positive surprise on the revenue, and they're also consistently giving a positive surprise on the EPS, earnings per share itself, except for 2019 here it's a negative. And the impressive gross margin, as you can see here, 76%, 75%. It's upper 75, 70s, which is very impressive. Coupled with the gross margin and the year-over-year revenue, I would really feel strong about buying this stock. Net margin is negative because it's a little bit early type company and smaller company. They're investing heavily into their R&D and product development itself. That's why net margin is low. They're really not making money at the end of the day after paying all the expenses. And they got not, it's a good amount of debt, not unmanageable, and they got good amount of cash in their balance sheet. And the price to sales ratio is it's becoming a little bit more now. which is something to watch out for. But if the company puts up this type of growth, revenue growth, I would be okay paying 52.45 multiple for price to earning. So overall, Cloudflare is a good company to own, clearly a leader in the market. Next is Zscaler. So Zscaler, it's again a 3-year chart. They've done 554.63% from 2018 all the way to 2020. In 2 years, 554% is very impressive. And a quick earnings, recap from December 2nd earnings. Their billing grows 64% year over year, and their deferred revenue grows 51%. So I keep a very close eye on the deferred revenue growth. That shows their predictability for the future revenue, which is very good. And as you can see, your market cap has increased in a rapid clip quarter over quarter, which is very impressive. And the revenue, as you can see here, they've been surprising the market with the positive revenue surprise, and they've been putting up very impressive revenue growth, 47, 36, 39. Latest is 52% year over year, which is very impressive. And they're also surprising on the earnings per share, as you can see here. And gross margin is in the 70s and 80s, which is SaaS companies will put up this type of gross margin because they develop the code once and keep marketing and keep selling it and get that gross margin. Net margin itself is negative, as you can see here, mainly because they're spending a lot of money in their R&D and the product development, which is understandable for a newer player. They do have some amount of debt, as you can see here, and they also have good amount of cash in their balance sheet. And price to earnings ratio, as usual, is a little bit higher, mainly because they're putting up so much revenue growth year over the year. So with that, let's look at next set of players here. Next is CloudStrike. CloudStrike is clearly a market leader in cloud security, and they have done very well. In 2 years, they have done 275% performance from a price perspective. And few call outs from the earnings. They've achieved 907 ARR, which is very impressive, and they also added 1,186 net new subscription customers, and they're also doing very well with the bigger customers. So it's a very impressive feat. And from market cap, as you can see here, consistently improving over the past couple of quarters, about $33.53 billion. And they've been surprising, in their revenue numbers to the market. And revenue itself is very impressive. As you can see here, 85% revenue growth over last couple of quarters. It's 88, 89, very impressive year over year revenue growth. And they're also very impressive when it comes to the earnings per share growth. They've done very well here too. Gross margin is very solid, very typical of SaaS companies. Net margin is negative. Again, they are investing in their own R&D and the product development. And very impressive cash, and debt itself is not there. So, when there is no debt, there is a lot of cash, and they're putting up this type of revenue growth. It's a recipe for success in my book. Little pricey with the 57% price to sales ratio, but very typical for a cloud-based company. Next is SailPoint Technologies. Like we talked about earlier, this is a identity management type solution, and a quick call out from their earnings. Their subscription revenue was 551 million, 36% increase, which is very impressive. Licenses revenue is 15% increase, and service revenue is about 4% increase, which is solid. And market cap, as you can see here, it's a steady eddy, I would say, slowly, consistently improving. quarter over quarter. The revenue itself, as you can see here, they've been providing positive revenue surprise in their earnings calls, and revenue growth itself is pretty impressive. It's consistently doing well from a year-over-year revenue increase. And EPS also is a positive surprise they're providing, which is very good. So as you can see here, CloudStrike, their year-over-year revenue growth is so steep, and these guys are a little more steady Eddie type. And impressive gross margin, impressive net margin. They're actually, end of the day, they are actually making some money here. And they got some debt, not too much, and they have cash at hand to withhold. And they're also not that pricey. 15% price to sales ratio. It's not bad at all. So it's a good company, a little bit lower stock price. Good to own. Next, we'll talk about next two set of companies. My favorite is Okta. Okta is identity management solution, and clearly, if you look at 3-year performance, 836%, which is very, very impressive. And they also provide some call-outs in their earnings call. They provide positive outlook for 2021. Subscription revenue grew 43%, and their backlog itself grew 53%, which is a very good sign that they can withstand and grow through their subscriptions. And market cap, as you can see here, it's growing rapidly quarter over quarter, which is a good sign. And the revenue itself, they've been positively surprising the market. And revenue growth for this big company, it's very impressive. 44, 44, 46, 42% revenue growth year over year. And they have been providing the positive revenue surprises, EPS surprise also, as you can see here. Impressive gross margin. They're still, not making money from a net margin perspective, expected because they're investing so heavily into their platform. And they do have good amount of debt, and they have cash also. And price to sales is, it's slowly increasing, especially with their, positive revenue growth. So I would recommend Okta because it's a very solid identity type company. I would recommend this. Next is Palo Alto Networks. So as you can see, it's got its ups and downs. For example, back in March, when everybody dipped with the COVID scare, these guys also dipped drastically. I would watch out for some of these dips and buy in those scenarios. Market cap is consistently improving, as you can see here. They have been surprising the market with the positive revenue surprise, except for back in April. This is during the COVID scare. And year-over-year revenue is also pretty steady, as you can see here, 22% year-over-year revenue growth, with about $1 billion revenue is very impressive. And they've been surprising the street with the positive EPS surprise, and gross margin is very impressive. And they are still not making it from a net margin perspective, but I think they're investing heavily into the platform itself. And they got some debt, or I would say a lot of debt, and they do have about same amount of cash here. And price to sales is not that expensive, so it's manageable. So it's one of those established type companies with a steady Eddie type growth. So with that, we'll look at last two sets of companies. One is Fortinet. Fortinet has got a 236% performance over past 3 years. And they also provided a quick call out in the earnings statement. The product revenue grew 14%, service revenue grew 22%, and billings grew 20%. And the revenue itself grew, overall revenue grew 19%. So market cap is improving at a positive clip over the last couple of quarters. They've been surprising the Wall Street with the revenue surprises on the upside. Impressive 19% year-over-year revenue, and they've been very consistent in the revenue growth. EPS also, it's a positive surprise last couple of quarters. Solid gross margin, solid net margin. They're also bringing the money in and saving some money also at the end of the day, and no debt here, and very good cash on hand, and impressive, not too much price to sales ratio, very impressive. So Fortinet is a good stock, with the these set of numbers. They've been doing very well. They've been steady Eddie, I would say, consistently doing very well. Next is Proofpoint. Proofpoint, as you can see here, it's got its ups and downs, and a very good company, as you can see here. You can trade in and out, in and out, in and out, and you could also do strategies like butterfly, iron condor if you want to, because it's got very good trading range type thing. Or you could do either buy put when it comes down, or sell some call spread if when it comes down. A lot of strategies can be done for Proofpoint, and if you want to keep it for longer term, you'd buy in a dip. So with that, couple of things from a earnings call here. The net billing grew 6%, and their positive free cash flow, and they also gave a good guidance for FY20. So with that, market cap is consistently improving, kind of steady Eddie, I would think. Had a little bit bump here, but they're doing well now. And they've been providing positive surprises from a revenue perspective, and also positive year-over-year double-digit revenue growth, and positive surprise from a EPS perspective quarter-over-quarter, and gross margin is very impressive, upper 70%, and net margin is okay. They are still investing in their platform, and they got good amount of debt, but they also have cash on hand. And as you can see here, it's the price to sales multiple is not high, which is a good sign. So this is a company that you can buy whenever on a dip. You're not paying too much money for this company, because price to sales is low. So that's a quick wrap. I think next we'll look at a couple charts here. We did not cover all the companies in detail. Let's look at Tenable Holdings. As you can see here, 3-year performance 73%. And as you can see here, it's a good company, and stock price is not very high. It's about $50, so steady Eddie type company. QLYS is again a good company, and it's I've been holding it for a while. It's a nice company to hold, solid company. As you can see here, it's consistently stock prices increasing. It's got its down, whenever it's down, you could buy and add to your position. F5 Network, it used to be good old company, and now I think it's transforming itself into a network security type company. And it's a good company to buy on dips and hold it, and you could even do some of these butterfly type strategies very well on this company. NortonLifeLock is a consumer type security company, and it's a solid company, low stock price. I would buy on dips and keep it and take it from there. So with that, we'll go back to our chart here quickly. And of these companies, I would recommend CrowdStrike, Cloudflare, Palo Alto Network, Fortinet, Checkpoint, Zscaler, Okta, SailPoint, Proofpoint, and QLYS, and Tenable Holdings. So with that, thank you very much. Happy trading.